So this tutorial is about guide to reading charts. Now, what is the philosophy or the rationale? Now, there are three justifications for charts. The first one is that market action discounts everything. The second one is that prices move in trends. And then the third one is that history repeats itself. That is the philosophy or the rationale for using the chart approach. Now, market action discounts everything. The statement market action discounts everything forms what is probably the cornerstone of technical analysis. Unless the full significance of this first premise is fully understood and accepted, nothing else that follows makes much sense. The technician believes that anything that can possibly affect the price, fundamentally, politically, psychologically, and otherwise, is actually reflected in the price of that market. It follows, therefore, that a study of price action is all that is required. While this claim may seem presumptuous, it is hard to disagree with it if one takes the time to consider one of its true meaning. All the technician is really claiming is that a price action should reflect shifts in supply and demand. If demand exceeds supply, prices should rise. If supply exceeds demand, prices should fall. This action is the basis of all economic and fundamental forecasting. The technician then turns this statement around to arrive at the conclusion that if prices are rising, for whatsoever the specific reasons, demand must exceed supply, and fundamentals must be bullish. If prices fall, the fundamentals must be bearish. If this last commitment or this last comment about fundamentals seems surprising in the context of a discussion of technical analysis, it shouldn't. After all, the technician is indirectly studying fundamentals. Most technicians would probably agree that it is the underlying forces of supply and demand, that economic fundamentals of a market, that causes bull and bear markets. The chart do not in themselves cause markets to move up and down. They simply reflect the bullish or bearish psychology of the marketplace. As a rule, the chartists do not concern themselves with the reasons why prices rise or fall. Very often, in the very early stages of the price trend or the critical turning points, no one seems to know exactly why a market is performing a certain way. While the technical approach may sometimes seem oversimplistic in its claims, the logic behind this very first premise, that markets discount everything, becomes more compelling. The more markets experience one gains. It follows then that if everything that affects the market price is ultimately reflected in a marketplace, then the study of that market price is all that is necessary. By studying the market, or by studying price charts and a host of supporting technical indicators, the chartist in effect lets the market tell him or her which way it is most likely to go. The chartist does not necessarily try to outsmart or outguess the market. All the technical tools discussed later are simply techniques used to aid the chartist in the process of studying the market action. Chartists know there are reasons why markets go up or down. He or she just doesn't believe in knowing what those reasons are, or that those reasons are necessary in forecasting the process. That is market action discounts everything. Everything that affects the market is ultimately reflected in the market price. The chartist knows that there are reasons why markets go up and down, but does not believe that knowing what those reasons are is necessary in forecasting the process. That is a good beginning. We will end this particular tutorial at this point in order to keep all our tutorials short and sweet, and we will continue in the next tutorial. See you then.